The pathway to consistency is achieved through a simple formula: improvement by subtraction. Professional traders implement specific structures that reveal opportunities to improve performance by simply avoiding poor decision making. This template is implemented by professional traders around the world. To find consistency, you just need a method to eliminate your poor decisions. Good evening, everybody, and welcome. Thank you for joining this live stream. Our topic for tonight is how to become a consistently profitable trader trading from your home. Okay, now where we're going to go with this, it's a very important formula, and I want you to write this down. And hopefully by the end of this, this session together, you'll really have a good understanding by what I mean by improvement by subtraction. Okay, so just a few little rules or the approach we're going to take for tonight. Keep the questions towards the end. Okay, I will make time for some live Q&A. So just keep those questions for later on, very simply. Otherwise, I'm just going to miss them. Okay, so what you're going to learn from this little lesson is what is the right kind of trader's mentality. So how do traders, professional traders, think in comparison to younger traders? What are the most common inconsistencies that traders face? 4 practical, simple tools and methods that you can adopt, today to start developing consistency in your own trading. How long it will take you to become consistent as a trader. How to access a 4-part training series, which is over 5 hours long. I'll give you the link for that. And then, as I mentioned, a live Q&A. Okay, so let's get straight into it then. And where we're going to start with this is this wonderful quote: anyone can make money. Only traders can hold on to money. And this is kind of this crux of where this, improvement by subtraction comes from. Okay. Younger traders, new traders are very fixated, very focused on trying to find the perfect trade, trying to find the perfect entry, trying, so much to just find profits. Professional traders are trying to find the perfect process. They're trying to find the perfect way to eliminate the mistakes that are holding them back. Okay. Now, some of the phrases that draw those comparisons between amateur traders and professional traders are as follows. Younger traders tend to think, I need a new strategy. Professional traders think, I need a new process to solve this problem. Younger traders think, I need another tool. Senior traders think, how can I remove noise and influence from my trading? Younger traders, I need to take bigger winners out of the market. Professional traders, how can I take smaller winners with more size or more leverage? Younger traders, I keep repeating the same mistakes. Professional traders, I keep repeating the same processes. Younger traders, I need to be on a trading floor to succeed. Professional traders, I need to keep working at my own game. Younger traders, I need someone to show me how to trade. And professional traders, I need to find a new way that works for me. And lastly, I need to improve my P&L performance versus I need to improve my processes. Can you see how the mental approach is almost completely opposite for amateur traders versus professional traders? Okay, and this stems from this idea of improvement by subtraction. Right? Professional traders are very fixated on how can I get that little bit better by improving what I'm already doing. Whereas new traders are trying to find that new cutting, tool or that new strategy that's going to suddenly make them profitable or add a certain moving average to the charts in hope that it's going to give them deeper understanding. Okay, so the mentality is very different between amateur traders and professional traders. Now, in terms of where we go from here, okay, I wanted to try and understand what's out there, what's in the public space. What do when traders come into this job, what do they think is required for them to become consistent? Because what I want to do is get an understanding of what's out there versus what do professional traders actually do to become more consistent. Okay, so what I'm showing you guys, what's out there, it's what's expected of you. All right, so in order for you to be consistent, you've got to set realistic goals. Okay, and by the way, you can go type this in Google, how do I become consistent as a trader? And most of these will come up. Okay, so it's public information. So you got to keep it simple. Okay, you got to maintain a trading journal. You got to develop clear exit rules for your trades. You got to always know your maximum loss on a trade. You need to leverage your best trade strategies. You need to keep trading statistics, develop a playbook of your best trade setups, prepare consistently, stick to the plan, and focus on less. Okay, so these are prerequisites. This is what, the theory books say. The theory books say you need all of this in order to be consistent. Now, here's the question for you, and I want you to think about this for a second before I move on. Okay, this is the question. With all that theory, we've got those key 12 points or 14 points, whatever it is. The theory says that if we adopt those practices, we should become consistent. So why do over 85% of all traders, and this is a statistic taken from the United States, why do over all 85% of traders fail if the probability of market outcomes is a 50-50? In other words, the market can only go up and down. Okay, it's a 50-50 outcome. So why is it we've got such a high failure rate? We've got all the theory is there. It tells us if we do these things, we'll be consistent. And if we're consistent, therefore we are profitable, which means we're not a failing trader. Yet the odds are so heavily stacked against traders to fail. So why? Why is it? What do you think it is that we've got all the theory, yet we're not capable of being consistent? Now, it's a simple answer in a sense. And again, I can probably say that because I've been doing this job for long enough. For most of you that know me, this is my 10th year as a trader, as a professional trader. And the answer is quite simple. Yes, we've got the theory. Yes, we know we need a trade journal. We know we need to track our statistics. We know we have to be disciplined and patient and all. We know these things, okay? But there's a real lack of structure and process and methodology that actually works. Okay, so what do I mean by that? For example, we all know we need a trade journal, right? So we've got all these trade journals now, these tools that are available, and we go and purchase one of them, yet that tool doesn't actually solve any problems for us. It has no real value add. Okay, and I found that firsthand, by the way. So for a large part of my career, I used Evernote. Okay, and the reason I used Evernote was because it was a journal that I could use on my phone or my home computer or the work computer. So my data was up in the cloud the whole time, very easy to access. I could type notes on the tube in London or on the bus or whatever. Okay, so that's why I used Evernote. I could embed charts into it, etc., etc. But the reality was, at some point, I recognized that there's a shortcoming of Evernote and a lot of these trading journals, which is that they do not allow me to take qualitative data and turn it into quantitative data. In other words, all these notes, all these thoughts that I was, typing out and the hours spent reflecting, I was incapable of using that data in any other shape or form. Okay, so yes, Evernote did add value to me in some shape or form. Okay, but did it solve one or some of my underlying inconsistencies? Okay, and that's the problem, is that we've got the theory, we know what we need to do, but we don't do it in the right manner. In other words, we're not journaling the right way. We're not managing our best trades in the right way. We're not solving our problems of being inconsistent. Okay, now what I'm going to show you today is I'm going to show you 4 tools, 4 approaches that you can adopt today, 4 things you can take away from today and apply them straight away. And as by definition, you should become more consistent as a result. Okay, very simple fixes. So the first thing, before we can get to the tools, let's talk about some of these inconsistencies. Big blowout days. Okay, and hopefully you can all associate with this. You should all see at least one or more of these within yourself. Okay, I can see one or more of these within myself, and I've been doing this for longer than most of you. Okay, so the big blowout days, right? The lack of specific trading structures and processes. Right? That feeling of I'm not in control, that feeling of, today I did this, tomorrow I do that. It never feels like it's the same thing. It's that insecurity, that lack of security. Moving trading stops. How often do we do that? Changing the predetermined plan. We come in thinking, today I'm going to trade the S&P 500, and we end up trading the NASDAQ. Okay. Gambling trades. How often do we put on trades? We get to the end of the day, we're like, I had no intention of trading this market. Something came out on Twitter, or maybe there was a Reuters release, and suddenly I'm trading a market that I had no intention of trading. Emotional risk management. Okay, how often do we get close to stop? Suddenly we've lost more than our stop. The next thing, we've lost 5% of our account in one day. Bias avoidance. Okay, so often we come in with overconfidence bias or recency bias or small sample bias. I mean, there's 101 different trading biases we suffer from. Right? And we come in with those biases. Lack of forward trade statistics. Okay. Nowadays with professional traders, I see it so often. Oh, not professional traders, with a lot of young traders, is they trade a trade 5 times, or they get a sample of 5 trades, and suddenly they think they've got a great trade. Okay. And there's this real lack of forward trade statistics. They haven't actually put that trade into a real forward environment to test if it's any good or not. Accountability, right? We hate facing the facts. As traders, we, one, don't have the data to face the facts, but two, when we've got the data, we shy away from it. We're afraid to front up to the information at hand. Information overload, right? If I take one look at young traders' charts, there's far too much going on. There's far too much information that a trader is expected to absorb and then make good decisions from. Lack of rules-based decision-making, or lack of 100% focus. Okay, these are the most common inconsistencies. There's a lot more than these, right? But with all the traders that I've mentored over the years, these are the inconsistencies that come up time and time and time again. They are the most consistent for common for a reason. And more importantly, if you solve some part of these or you eliminate some of these, you're going to see consistency. Okay, and that's the objective. The whole concept of improvement by subtraction is saying, if I can today, at the end of this trading session that Brannigan's doing with me, if I can apply one of his tools and remove the big blowout days, by removing that inconsistency, I become better. I progress, I improve because I subtract. Think of that mindset shift for a difference, for a moment, sorry. Most young traders, at the end of the day, are going to go and research about their trade strategy, or find more, trade strategies, or look for different trade strategies, different ideas. Are they actually going to improve? No. They're just going to keep going around chasing their tail every single day. Okay. Where they need to be looking is they need to be looking at the problems, the inconsistencies, and eliminating them one by one. In other words, today I came in, I have my one strategy, and for some reason, I traded 3 other trade ideas. How do I eliminate that? How do I avoid doing that the next time? Because if I remove that inconsistency, I will become more consistent. And that's what this is about. Improvement by subtraction. Okay, so if I eliminate one inconsistency, what happens to my consistency? That's the question, and the answer is improvement by subtraction. Now, let's look at it. We've got 4 different approaches you can take. I'm going to teach you 4 different methodologies. Okay, take this from a professional trader who's done this for 10 years now. Tool number one. Now, you wouldn't have heard of this. And there's a lot of traders that, hopefully if there's one thing you take, this is something that's been extremely profound in my 2021 year. It's a new concept that I stumbled upon. It's not mine. And it's this concept of optimize our default decisions. Okay. So what is a default decision? It's very simple. It's our default choice. Now, the way to think of this is I'm going to frame a question to you. When you wake up in the morning, what's the first thing you do? The very first thing you do, okay? Besides going to the toilet and all that, okay? What's that first thing you do? Okay? Now, a lot of us are going to answer maybe turn the alarm off, maybe put the kettle on, maybe read the news, okay? So that's your default choice. In other words, it's the decision you make without any thought or clarity or logic. It's simply an autopilot decision. You make the decision by default. Now, what if I told you that by removing certain elements or changing certain elements, you could take that default choice and make it to your benefit? In other words, you could put yourself in a position of power simply by just adjusting your default choices. Okay, for example, one of the biggest mistakes that I made up until this year, and I know it's been a bad mistake, but I never knew how to actually solve it, was the first thing I do in the mornings once I put the kettle on is I sit down and I'm reading the news. I'm looking what's happened in Asia, what have the markets done, trying to formulate my game plan whilst I'm still trying to wake up. Okay. Now, the problem with that is you frame your mindset. The moment you're reading the news, you're giving yourself a bias. Okay, because, China sold off because of Evergrande, and suddenly now, yesterday I wanted to be short equity, so I'm going to be short equities. I wanted to be long yen because that's the risk of play, and I like the gold breakout. So suddenly, you've got a bias just by reading the news. You haven't thought of anything else, and you already have a bias. Okay, how about when we come in the morning, right? So often when we've read the news before we look at our charts, we're being subjective as opposed to objective. Okay, price doesn't lie. If the price is showing us that price is going higher, but the newspaper article says and suggests price should go lower, suddenly we're creating and inviting just all these question marks. Okay, so by the way, the default choice is very simple. First thing you do in the morning is you do not have your phone with you. Okay, you do not look at your phone for the first 2 hours. Second thing you do when you get into the office, the first thing you do is your technical analysis. Then do your fundamental analysis. Then go on the Bloomberg terminal and check the news. Then go and read Reuters. But first do the technical analysis. Okay. Notice how we're just changing the default choice. Right? If you're someone that drinks too much coffee, by the way, it's very simple. Get rid of the coffee in the house. Just don't have coffee in your house. It is as simple as that. Because when you get up in the morning, oh, hey, well, I've got tea. That's a good substitute. I'll have that instead. Okay. What about the end of the day? Okay. So often, the end of the day, I'm doing my debrief and I've got the price ladders up, and the next thing I see something moving around. What do? Oh, click, bang. I'm in the market again. What happened there? Because I've got the system open, my default choice is I'm going to instinctively react. So remove it. Close the system. Okay. Our phones. How much of a distraction do our phones provide? Okay. My phone is literally always upside down. It's always on silent. My wife hates it. Okay. But simply by turning my phone upside down and turning it on silent, I cannot be distracted by Twitter, Facebook, Instagram, any of these things. I cannot be distracted. And if someone calls me an insurance broker who wants to sell me or mis-sell me insurance, guess what? He's not going to bother me. He's not going to irritate me because I won't even see him calling. We just change our default choices so that they give us a little bit of an edge. Now, something as simple as this can really make a profound impact on the decisions you make over the course of the day. And there are so many default decisions that you can adjust to your benefit. Okay. The last one is alarms. Okay. I use a lot of alarms. So I have an alarm going off obviously in the morning. Okay. I have an alarm going off for lunch because I struggle to get up and go out and I know I need to. I have an alarm going off telling me this is the end of the session. You're done trading now, finish. Okay. I have an alarm going off when I reach a certain P&L target. I have an alarm going off when I hit a certain downside target. Okay. I have these alarms so they break the discrete process for me. Okay. Well, trading is continuous, so it's always going. So I need something to intervene. And that's what alarms do for me. Okay. Think about default choices. What are the default choices you make and what can you do to those default choices to have them working in your power? Okay. So that's our first tool. Now note, we had our 12 different, inconsistencies. All of a sudden, just by changing some of our default choices, we can improve our emotional risk management. We're more balanced. Our psychology is better balanced. Why? Because we're not spending our time reading about all the rubbish going on in the world first thing in the morning. Instead, we're focusing on our meditative state. Where are we at? Visualizing what we did well the previous day. Visualizing what we want to be today. Okay, simple fix. Bias avoidance. Suddenly, we're going to improve this inconsistency because we're not coming in biased the moment we step into the office. Accountability, okay, and lack of 100% focus. All of a sudden, these 4 inconsistencies we've improved on with a simple tweak, a simple fix. We didn't have to go look through hours of charts. We didn't have to go and be super intelligent and do all these crazy things. We simply just make little fixes. Let's go on. Okay. So again, I'm going to come back to this. If I eliminate one of these 12 inconsistencies, what happens to my consistency? By definition, improvement by subtraction. Next one. So what's our second tool? Again, and this is a very important tool. We all debrief, okay? We all should debrief. We know that. And I showed you this in the beginning. The mistake a lot of these journaling tools make is very simple. They do not give you framework. They do not give you structure. They do not give you an exact approach to do the same thing every single day. Now, traders need structure. Why? Because traders need to observe patterns. That's how we improve. If I do the same thing and I start to recognize, oh, actually, I keep doing this thing and it keeps costing me money, well, then guess what? I can do something about it. I can remove the inconsistency. And what happens? I become more consistent. Okay, so a simple fix. Go to your trading journal today, wherever it might be. It might be Evernote, it might be Microsoft Word, it might be an A4 piece of paper. Okay, go there and write out 4 questions, just 4 questions, or use the questions you've got on screen right now. And for 1 month, I challenge you, answer those questions, the exact same questions every single day for 1 month, and come back and tell me what that does in terms of you starting to recognize certain patterns within your decision making, certain patterns within, how you do things well, how you do things badly, certain, patterns in terms of the corrective measures you take. Simply asking the same structured questions every single day is going to allow you to become more accountable. It's going to make you 100% more objective. You'll start to accept things for what they are. You'll get a deeper understanding of who you are. You'll find those areas you really need to work on. More importantly, you can take corrective measures for those areas. Okay? As mentioned, you'll start to see the patterns. You'll recognize the patterns. And lastly, you'll have a very good level of preparation coming into the next session. Simple fix. We're not doing anything crazier. We're not, reinventing the wheel. We're just taking our journaling approach and giving it methodology, giving it structure, giving it precise process. Okay, and you're going to hear me use that word a lot. Process, structure, methodology, because guess what? That's what professionals do every single day. Process, structure, methodology. Go back. What's not working in my process, structure, methodology? Improve. Process, structure, methodology. Come back. And it goes over and over and over again. We're not fixated on P&L. We're not fixated about making more money. We're not fixated about finding a new strategy. No, we take what we've got. We eliminate the inconsistencies to become consistent. Improvement by subtraction. Okay. So what do we do now? All of a sudden, we've got a structured approach to our journaling. Okay. So remember what we said on the internet tells us we need journaling. And that's true. We do need journaling to find consistency. Okay. But what the internet doesn't tell us is how do we structure a journal so that it actually makes us consistent, so that it actually adds value, right? And there's the answer. Structure it with the same questions. Answer the same journal every single day, okay? So what does that solve? Which of our inconsistencies have we improved on now, all right? For one, lack of specific trading structures. In other words, because we're asking the same questions, because we're recognizing patterns within our decision-making, suddenly we're starting to see structure. Suddenly we're starting to recognize that we do things in a certain order. And from that, we can take corrective measures, improve our structure and process. Okay? Changing the predetermined plan. So we can start to understand, how did I get to the point that I changed the plan that I had in the first place? Right? By going back and asking those same questions, we're going to be able to answer this. Remove the inconsistency. And lastly, information overload. Okay? Traders spend far too much time in a journal. Take it from me. You don't need more than 30 minutes in your journaling. If you're spending more than 30 minutes, newsflash, we can only focus for about 20 minutes effectively. Okay? So if you do want to spend more time, hit it for 20 minutes, 25 minutes, take a break. Okay? Come back maybe a few hours later, hit it again for 20 minutes. That's going to be more effective. Don't bluff yourself into thinking sitting there for an hour is going to make an effective debrief. It isn't. I've been doing this for 10 years. Trust me. Don't waste your time. Spend 20 minutes, hardcore minutes, really fixated, focused on just answering those 5 key questions for 1 month, and you will see your inconsistency become consistent. So, if I eliminate one inconsistency, what happens to my consistency? Improvement by subtraction. That's 2. Okay, that's 2 quick fixes. You can apply them straight today. Okay? You can go away and you can become more consistent for the first 23 minutes we've been talking. Okay, all of a sudden, the big blowout days disappear. Why? Because the system says you stopped out. Okay, so I'm not having the 10% drawdown or the 20% drawdown. And by the way, 20% drawdowns, you don't come back from those. You don't. And if you do, it's going to take you a couple of months. And if you don't learn the lesson from it, at some point, you're going to take a 20% drawdown to a 100% drawdown. Okay, again, take that from my experience. I've had the bad drawdowns. I know what it's like. All right, moving trading stops. How often do we move trading stops because maybe we've got the wrong trading stop, maybe we've used the wrong size on the trade, maybe we're just afraid to lose and accept, the trade being wrong? All of a sudden with a risk protocol, because everything is pre-planned, predetermined, we don't need to move stops. We're just following a structured plan. Lack of forward trade statistics. Again, the moment we've got a risk manager involved, we've also got forward trade statistics involved. We remove the inconsistencies and we suddenly become more consistent. Improvement by subtraction. We create a simple risk protocol, the most simplistic risk protocol. I have $1,000 stop a day. I do 5 trades a day on average. I'm going to risk $200 per trade. There you've got a simple risk strategy protocol. Yes, you can add all sorts of other sexy features to it and you can get a little bit more complicated with it. But something as simple as that is going to remove some of the inconsistency and make you more consistent. Okay, our last one. Tool number 4, access methodology. Now, this is a fun one. This is relatively new. You wouldn't have heard of this, by the way, because it doesn't exist. Right? This is something that's very much been around the Axia group, probably for the last 3-4 years. And the best way to think of access methodology is it's a precise signaling to enter a specific trade strategy. Okay. Now, the example I like to use is a breakout. We all know what a breakout is, right? A market starts to quail and all of a sudden it breaks. It moves aggressively in one direction. Now, back in the day, as traders, we used to preempt. We'd go, okay, I think this is going to break out, therefore I am long. I'm long for the breakout, and we preempt it. Now, the problem with preempting is that you're assuming that the market's going to break. Okay, you're assuming a number of things. You're assuming the probability is high that it's going to break. You assume it's going to break and continue. You assume that you are right in terms of your timing. Okay, so the Axia group went one step further. We said, yes, okay, our assumption is fair. There's that intuition. We've got a deeper understanding of this is going to break out. And we've got that one part of the analysis, which is what we call the structure of the trade. Now, the access just says, well, look, what happens if we can combine this strategy with a timing signal? Something that says, Brannigan, this strategy that you're aware of, now's the time to go for it, because now you get maximum risk reward to take on this opportunity. More importantly, you don't need to improvise. You don't need to preempt it, because the timing is telling you that there's now mass participation. And that's all access methodology is. It's saying, hey, Brannigan, there's a whole bunch of traders now that agree with your analysis. They agree with what you think, and they want to partake in this breakout. So now is the time for you to get onto that breakout. That's what access methodology is. It's a very structured, rules-based approach to trading. Now, it's not the only way to trade. But notice what I said. It's a rules-based, structured approach to trading. In other words, if A, B, and C exists, I do D. Nothing in between. There's no gray matter. It's as simple. If A, B, and C exists, I do D. It's as simple as that. It's rules-based, structured. Can you see how if we have a rules-based approach, suddenly the inconsistency, we now become more consistent? Okay, so the example I like to use, and again, I'm just going to show you this. I'm not going to go through it, but one of the examples of an access trade, particularly with breakouts that works quite nicely, is where we've got something called high volume, high delta volatility candles. In other words, what you'll typically see, and I'll give you a little hint, go away and have a look at your breakouts. If you're a breakout trader, go and have a look at a couple of your best breakout trades, okay? And rewind to just before the breakout. What you will notice is that very typically, the characteristic that exists in most of those breakouts, pre-breakout, is the volatility landscape changes. In other words, you start to see, think of it as a little bit of a rumbling, like a volcano that's about to erupt. It starts to become a bit more noisy, right? The range expands a little bit. You see a little bit more volume, a little bit more hive of activity, pre-breakout. And then post-breakout, obviously, now everyone's in, okay? Because now all the stops are going off, the liquidations are occurring, the mass participation is occurring, and everyone is now seeing the same thing, right? But the edge in breakouts is not in being late to the party. It's not in, getting in after the break. It's recognizing when that timing is perfect just before the break. And that's the access methodology that we adopt as professional traders. Okay, so again, there's an example of it if you want to go look at it. Bitcoin is very nice, by the way. Go look at Bitcoin from the 16th of December. Very good access methodology. A lot of the Axia traders did quite well on that. Not because we are amazing traders, okay, but because we've got amazing methodology, amazing process, amazing structure. Remember that. This is not a game of being right or wrong. It's a game of what is my process, what is my structure that I adopt on a day-to-day basis, and how can I keep removing the inconsistencies so that I become more consistent. Okay, so again, having something like an access methodology, a very simplistic, structured, rules-based approach to trading. What does that mean for me? That means that suddenly, suddenly my lack of rules-based decision-making is now removed. Okay, I now have a structured approach to how I take and make decisions. Now, the final question, if I eliminate all inconsistencies, what happens to my consistency? And again, I know I've driven that home, and that's why I said to you, write it down at the beginning. Improvement by subtraction. Become consistent by removing the inconsistencies, the things that are causing me to be inconsistent. It is as simple as that, okay? But let's go further. All right. So how long does it take to become a consistently profitable trader? It's not a straightforward question. A lot of people will lead you to believe it is straightforward, but it isn't. But I'm going to give you a simplified answer to it so you've got something to work with, a framework that you can work with and go away to think about. So the first thing you must think about is, how fast can you accumulate experiences through key lessons? Okay. In other words, if you want to become consistent, you're going to have to expose yourself to a lot of different experiences, because only when you go through a lot of different experiences will you see the inconsistencies. Okay. It's a bit like, think of sports. If I'm a sportsman and I've never ever participated in a sport when it rains, okay, then how am I expected to be consistent in rainy weather or poor weather? Well, it's simple. Train in bad weather, train in the rain. Okay, the more I train in the rain, the more I expose myself to different experiences, the more I can remove the inconsistency and become consistent. Okay, simple analogy, but hopefully the message is clear. The second one, how fast can you mitigate and eliminate inconsistencies? And this is important, okay, because you're all going to assume, you're all going to walk away really pumped, really motivated. You're going to be like, wow, this framework, it's excellent. I know what to do now. Finally, my problems are solved. The reality is that to eliminate inconsistencies, you first have to determine what your inconsistencies are. And that takes a bit of time, okay? Remember what I said to you? I challenge you to go do a debrief for a period of a month, ask the same set of questions. And the reason I get you to ask the same set of questions and why professional traders use templated debriefs is so that we can determine what are those inconsistencies. Okay, you're only going to pick up on them over a number of observations. So it takes time to figure out those inconsistencies. Okay, remember me, it took me 1.5 years to figure out why the heck I was losing so much money fading trend days. 1.5 years. When I finally solved that problem, suddenly I got a big boost in terms of my consistency. Okay, so that's important. Remember those two things. Now, it took me, okay, so I started trading in 2011, end of 2011, and it took me 15 months to go from, again, I wouldn't say I was an inconsistent trader. I was relatively consistent from day one, but I was covering costs, paying myself a wage after about 15 months, okay, 1 year and 3 months. I've seen quicker than that, and I've seen slower than that. I've seen some traders take 6, 7 years, and now they're finally consistent and making really good money. Okay, the point is you go at your own speed.